All right, so let me know if you think that this swing trade idea is crazy, but I wanted to run it past you guys, so let me know down in the comments section. So I plugged this into my risk to reward ratio calculator, and I came back with a 2.3% or 2.3 risk to reward ratio. So I'm not super excited about that, but let me explain, right? So this calculates, okay, with 500 shares, it's about $5,000, how much I could potentially make versus how much I could potentially lose with my desired entry of $11.35, my desired exit of $12.50, which is from here to here, and then cut losses at 1085, which again, you might be asking, Ricky, where the heck are you getting 1085? If we look at previous lows, that was 1086, the previous lows that we formed before. So if it breaks below that, that's a break of support. So I potentially want to cut losses there. Very, very simple. So the first thing that I want to explain is, well, first off, why is it selling off? Just like I explained in my video yesterday, one of their executives is stepping down. He originally joined the company back in 2004. Then he got upgraded to his position in 2022. And then since then, now he's stepping down from his role, as well as their guidance for Q2 of 2024 was lowered. So we're seeing a lot of selling pressure. American Airlines is down 14%. And this sucks for current investors. But for people like you and I that have no open position, as you guys could see, is this a potential dip buy opportunity? Now, swing trade doesn't mean that I have to hold this for a long period of time. It just means that, hey, if it sold off enough and it was an overreaction and it tries to recover, then I can make money on that potential recovery. This is the thing that I love about a lot of people say that, no, the stock market, when it comes down to investing, is not about timing. Well, I'm not investing, right? This is why the trading is all about timing. It's about identifying an opportunity that tends to be short-lived and that we're able to buy the dip very quickly. And then if it begins to recover, we can add more size and make money as it actually begins to indicate signs of that recovery. And that's exactly what I wanted to do here, right? Because if we look at this on the 5-minute time frame, we could see that we're beginning to consolidate. So it's not really indicating signs of progress yet on the upside, but it's not really making lower lows anymore, at least not yet. And with my desired entry of 1135 and my desired exit of 1250, right? So for right around 1135 and my desired exit of 1250, which is right around this area where we saw a lot of consolidation and below the moving average as of right now. Again, we can see the overall percent return. So from 1135 to around 1250, we're going to be working with about a 10% margin. But again, there's still downside, so I'm going to have to manage and mitigate that risk if this thing begins to go south. So you might be asking, well, Ricky, how did you come up with those 500 shares? If you look at the 500 shares, that's about $5,600, about $5,600. Why so little? With what it is that I trade with, that's a very small position, right? It's about 1% of what I tend to trade with. Well, the whole idea behind this is that, it's sold off 14% and the cheap can always get cheaper. I'm doing this one more for fun because, it offers really decent upside, but I know that this thing can continue to sell off. So instead of just obsessing, which I've done so many times in the past before, instead of just obsessing about like, hey, I'm going to buy the dip with $500,000 and when it goes up, I'm going to make $50,000 because it offers 10% return and that's going to be my plan. Well, no, right? I mean, the cheap can always get cheaper, and anytime that you take advantage of a riskier trade, your exposure to risk is also much greater. So a great way to be able to manage your risk is by managing your position size. And this is what I always share with my LPP team, is that if you struggle with trying to be too aggressive too early on, then managing your position size and keeping it small or keeping it light in the early parts of this position, right? So let's say I go in with 5,000 shares right around 1135, but then it actually begins to indicate signs of an uptrend. I can always add more to my trade if direction is in my favor and it's actually going according to plan. But if it's not going according to plan and then it breaks below support and begins to sell off, then great. I only went in with a very light position, which means that according to my trade plan, I am only going to lose $250. And for me, based off of what I normally trade with and what I normally can tolerate to lose, $250 is a drop in the water, right? So I put myself in a position to succeed, not because this trade has to go exactly according to plan, but even because of worst case scenario, I lose $250 and I can easily tolerate that. And that's kind of what I wanted to express to you guys, is when you plan out your trade, right, and you plug it into the risk calculator, do you put yourself in a position to succeed? Or is it a make it or break it, where you feel very stressed every time that you take a trade? Now, don't get me wrong. It's nice sometimes when you take an aggressive trade and it goes according to plan and you make a ton of money. Trust me, I love that. But guess what? Not every trade has that level of confidence. Not every trade also offers that little amount of risk. When you have more exposure to risk and you understand that the stock can get worse before it gets better, it is your job as a trader to realize that and identify that, and then to not put yourself in a position that might expose you to that type of risk that you simply cannot tolerate just yet. And this will begin to make more sense as you become a little bit more well-versed with the market. And it's kind of like, okay, when I trade meme stocks like AMC and GME, I don't mind trading them. I just give them less size. So my exposure to risk is much less because they're riskier stocks. If I'm trading something like Apple or Nvidia or something that's a blue chip stock that doesn't tend to be as volatile or as risky, I might be more comfortable giving it more size because it has a history of being less risky and less volatile. Make sense? So I just wanted to share this idea with you guys. Let me know down in the comment section what you think. This is definitely not a trade that I've taken just yet, but I wanted to share the idea with you and see what you guys thought. Again, these are concepts that we always talk about during our live trading sessions. I talked about it today with my LPP team, and I'd love to invite you. If you learn best by watching other people do, I trade live every single morning right at market open and would love to invite you. If you want to tune on in to watch me trade live as soon as tomorrow, it's the second link in the description down below, and we're running a 50% off discount right now. Also, if you guys haven't downloaded this risk calculator, it's free. Just shoot me a direct message right now via Instagram, which is linked in the description down below. Send me a direct message, risk calculator, and I'll send it right to your inbox. It's actually a bot. So once you message me, it will automatically respond with the actual Excel sheet that you can download for free. So we make it super simple. So just send me a direct message via Instagram and I'll send it right to your inbox. I appreciate your time. I hope that earned your thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take care, team.